Hi, my name is Catherine, and I would like to talk about the tools for financial statement analysis. Investors and creditors analyze financial statements to make investment and lending decisions. In doing so, they need to analyze 3 to 5 years of data to accurately determine the financial performance of a business. The analysis includes looking at the performance of the business from year to year, comparison with competitors, and the industry. The tools that we use for an analysis are horizontal analysis, vertical analysis, and ratio analysis. Horizontal analysis compares one year to the next. All 4 financial statements are analyzed with this tool to uncover important trends and changes from year to year. Vertical analysis shows the relationship of each item on the financial statement to its base amount. The income statement base is net sales, while total assets serve as the balance sheet base. The ratio analysis allows for comparison from one firm's earning history to another, along with many other indicators of financial health. No one ratio tells the whole story, so several are used. People that use the financial statement analysis are creditors, who is anyone who has lent funds to a company, investors, both current and prospective investors, management, the company controller, or regulatory authorities. So if a company is publicly held, its financial statements are examined by the Securities and Exchange Commission. Let's look at how we can use the financial statement analysis to examine the different aspects of a company's performance. We will first look at liquidity ratios. These are things like cash coverage ratio, that shows the amount of cash available to pay interest. Current ratio, which measures the amount of liquidity available to pay for current liabilities. Current quick ratio, which is the same as the current ratio but does not include inventory. And liquidity index, which measures the amount of time required to convert assets into cash. The next one is activity ratios. This is accounts payable turnover ratio, which measures the speed with which a company pays its suppliers, and accounts receivable turnover ratio, which measures a company's ability to collect accounts receivable. Fixed asset turnover ratio, which measures a company's ability to generate sales from a certain base of fixed assets. Inventory turnover ratio, which measures the amount of inventory needed to support a given level of sales. Sales to working capital ratio, which shows the amount of work capital required to support a given amount of sales. And working capital turnover ratio, which measures a company's ability to generate sales from a certain base of working capital. The next is the leverage ratio. This is the debt to equity ratio, which shows the extent to which management is willing to fund operations with debt rather than equity. Also, the debt service coverage ratio, which reveals the ability of a company to pay its debt obligations. And fixed charge coverage, which shows the ability of a company to pay for its fixed cost. And lastly, it's profitability ratio. This includes the break-even point, which reveals the sales level at which a company breaks even. The contribution margin ratio, which shows the profits left after variable costs are subtracted from sales. The gross profit ratio, which shows revenues minus the cost of goods sold as a proportion of sales. Margin of safety, which calculates the amount by which sales must drop before a company reaches its break-even point. Net profit ratio, which calculates the amount of profit after taxes and all expenses have been deducted from net sales. Return on equity, which shows a company's profit as a percentage of equity. Return on net assets, which shows company profits as a percentage of fixed assets and working capital. And then return on operating assets, which shows company's profit as percentage of assets utilized. We must also remember that there are always ethical issues related to any form of accounting, and that also includes financial statement analysis. The importance of ethics and standards of integrity are especially important to an accountant who is responsible for handling the company's financial statement analysis, because if the accountant is not honest, it can shine a negative light on the profession as a whole. Professionals going into this line of business must also recognize that ethics and integrity are central to the value they bring to the clients they serve. Clients rely on accountants to perform their jobs with the highest degree of accuracy and ethical integrity. Leviticus 19:11, the King James Version, states, "Ye shall not steal, neither deal falsely, neither lie to one another." Thank you and God bless.